IFRS 9 looks at financial instruments, and IFRS 9 is probably the most complex accounting standard out there. And so because of that, we are just going to look at one small area of the standard, and that's going to be the classification of financial assets. So in this, we're going to look at equity investments and debt investments. Now, equity investments will just be investments in shares in a company, and there are two options for firms to account for these. The default position is fair value through profit or loss, where you just revalue that investment to fair value and the gain or loss hits the P&L. Now, obviously that could be quite volatile, and so firms can make an election to hold those shares at fair value through other comprehensive income. But that election needs to be made immediately when those shares are bought, and it is irrevocable. It has to be kept for the whole time. So you still revalue that investment to fair value at year end, but the gain or loss is held in a reserve, much like revaluation of a property. Now that can be a negative reserve. So even if that's a loss initially, it doesn't hit the P&L, it goes as a negative reserve. And that is there until the asset is disposed of, and when it's disposed of, that reserve gets moved to retained earnings, but never hits the statement of profit or loss. For debt instruments, we're looking at things like loan assets or bonds, which have an element of interest and repayment to them. Now, to account for these, you record the interest income at the effective rate in the statement of profit or loss. And the value of the asset will decrease when you receive your annual payment. Now, the default position of these is again fair value through profit or loss. But a lot of firms maybe don't want to use that because actually these loans may just be a simple loan to a third party or government bonds that they're holding to earn interest and then get the cash back. And so they can elect to hold them under amortized cost depending on the business model that they have. Now, if that business model is that our intention is to hold it to gain the interest and then get the cash back at the end, you can elect to have that as amortized cost so you don't revalue it at fair value. If your business model is that with these bonds and loans, you don't generally sell them, but you might sell some, you can elect to hold them as fair value through other comprehensive income. So you revalue them at year end, but again, the gain goes to a reserve and not to the statement of profit or loss. Now, IFRS 9 also covers things like hedging and impairments of financial assets, which are very complex. But in terms of the financial assets, it's important to know that for equity investments, there are two alternative treatments, and for debt investments, there are three alternative treatments with a few criteria you need to meet to elect to hold it as amortized cost.